Well, happy Wednesday, everybody. Thanks for joining us at our normal time with a little bit half hour early, and that's due to a special guest that we have, Jeff Murtha with MassMutual, one of our newest friends here at Financial Brokerage, on the road and fitness into his busy schedule, so we appreciate him being here. He's a managing director in the field and expert on the MassMutual product portfolio and helping us and all of you get off the ground with MassMutual and increase productivity. So I'll turn it over to Jeff in a minute here so he can give a more formal introduction and talk about the presentation today. Just quick housekeeping. As you guys know, you guys will all be on mute, but that doesn't mean that we don't want to hear from you. We just want clean audio. So feel free to fire away with questions in the question box. I'll monitor that throughout the presentation, and we'll make sure we get all your questions answered as we go along. I think that's it from a housekeeping perspective. I know Jeff is on kind of a tight timeline, so I want to turn it over to him and let him kick it off.
Thank you, Tim. I really appreciate you being flexible and starting a half hour early while I'm out gallivanting in Minneapolis. As you can see, I got the nice Marriott behind me. As Tim mentioned, my name is Jeff Murtha. I am the managing director for MassMutual Strategic Distributors. I'll explain a little bit more what the strategic distributor part means alongside MassMutual. I am, for what the title says, an external wholesaler. I meet with folks like you and try to help tell the MassMutual story in a place where I don't think we did a good job in the past of telling independent agents how MassMutual really works and where you can be a benefit to your clients. So the intention of today's presentation is going to have a little bit of a MassMutual slant in regards to whole life insurance, but it's really to inform you and educate and be as objective as possible. It's about how this can be a good fit for your customers. A little background on myself. I've been wholesaling for 14 years, and with a couple carriers. And most of my background is with Universal Life. So I have a very deep appreciation for a lot of the products that you sell currently today. I've been a part of a lot of BUL, current assumption UL, a boatload of GUL back in the day, as well as helped to launch an IUL at one carrier. And I was at another carrier where all we sold was Index Universal Life. So I understand where everything fits, and it's my belief that every single life insurance product out there has a fit, and it's been designed by an insurance carrier to do good things for the customers, whether it's pay a death claim or have cash value for whatever that need might be. And it's our job as advisors to be able to line up those different options and present the choices that make sense for that client's unique situation. And I think where whole life insurance has been getting a lot of attention right now is that it's been easier to manage expectations around how the product is going to perform, especially from a cash value standpoint. And the trouble we have with whole life insurance isn't the certainty you get with it. It's just about understanding it for ourselves so we can then go out and have that discussion with our customers. So again, that's going to be the intention of today's presentation. If you have questions, feel free to get into the chat, and then Tim will stop me, or we can wait till the end if there's some questions that surface up. The title of today's presentation is Whole Life University, Myths and Misconceptions. Why is it called Whole Life Insurance University? Well, I'll explain that here in a little bit, but the agenda, we're going to talk about why MassMutual is in the independent space, and prior to a couple of years ago, we didn't really have much of a presence, but there's a really, really strong reason or reasons for it. We'll talk a little bit about the past, the present, and the future when it comes to products and carriers. And then we'll get into the myths and misconceptions. And really, these are just objections that we ourselves have to selling whole life insurance. And there might be some folks on the phone who have actually sold whole life insurance before. And this is just a little bit of a refresher, or you want to see what MassMutual has to offer. But for the folks who are new or newer in the last 20 years and they've never sold whole life insurance, we've really only sold against it. And we kind of have this built-in preconceived notions about how the product operates. And again, that's probably because there hasn't been a whole life insurance carrier in the independent space with some real meaning to be able to help educate on these products. So hopefully by the end of this, you're going to say MassMutual is probably one of the best things since canned beer, and we love it. Usually that's what people say at the end. So Whole Life University, the reason why we call that as the title is because we have a grouping of 5 different presentations that, if we go in order, will help deliver really conceptually how whole life insurance can work for all these different purposes. And the first one, as we discussed, is whole life myths and misconceptions, followed by whole life and accumulation sales, whole life and protection sales, demything the dividend, because I think a lot of people have trouble understanding how we actually get to the dividends that we post and pay to policyholders. And then the last one is understanding policy loans, because that's something, again, that we have a little bit of trouble with when it comes to whole life insurance. So the past, the present, and the future of product evolution, and this is just a little bit of a kind of a history lesson, and a lot of folks are going to probably be aware of this, but it does set the stage for why whole life insurance is getting a lot more attention today. So when there was only one permanent policy out there, whole life got a lot of attention, and it was the most sold product that was out there. That was the whole life area. When interest rates started skyrocketing in the mid-'80s, you saw a shift from whole life insurance to this new product called Universal Life. And the reason why is because Universal Life was a lot quicker to be able to attain interest rate crediting than what whole life insurance. Whole life insurance will kind of lag behind where interest rates go. So if interest rates shoot up really quick, then those products weren't able to capitalize on those current interest rate environments. So a lot of money in the mid-'80s went from whole life insurance out of those policy values to CDs and into universal life insurance. So as interest rates went down, unfortunately, you started to see those universal life products and adjustable life products not to perform like initially expected. But since the market was doing so good, we had that nice VUL boom. So in the 1990s and even in the early 2000s, VUL took the mantle as a top performer from a product perspective. And then after we had a few crashes, a really cool new product that, in my opinion, has the best story out there, which is Index Universal Life. To have zero be your hero and have upside potential of the market, who wouldn't want that? So it's kind of the best of both worlds. You got some of the protection and certainty offered with whole life insurance, and then to have upside potential in the market. It was a beautiful story. And so we saw a lot of volume and premium going to IUL. And what this graph tracks is the 10-year treasury rate and the S&P 500 value to help kind of articulate why some of these products were popular when they were. Now, the backdrop of this is very helpful, but one of the things that people don't know is that even through a lot of these different eras, whole life insurance was predominantly the widest sold product by premium and by volume. Now, you'll see on the graph further to the left that there was a period in the early 2000s where VUL was the, by premium, largest product sold. You'll see that in the mid-2000s that GUL, and actually mid-2000s to probably early 2010s, that GUL was the top seller. And actually, to the sadness of whole life insurance carriers, what funded a lot of that GUL in the mid-2000s to early 2010s was whole life insurance cash values transferring over. But for the most, I'd say the entirety of life insurance product history, whole life insurance has been the top seller and currently still is over the last 7, 8, 9, 10 years. A lot of people think IUL has been the top seller when actually it's been whole life insurance. So that kind of leads us to why are we here? Why is MassMutual in the independent space? Well, if whole life insurance is the top product seller, we should probably match that up with the top selling distribution, which is independent agents. Now, what you'll see here is that independent agents sell the most product, but in the grand scheme of things, they don't sell that much whole life insurance. So in order to match this up in a way that makes sense, at least to the people at MassMutual, they said, why don't we match up the top selling product with the top selling distribution? Hence why MassMutual Strategic Distributors was started about 2 years ago. And MassMutual Strategic Distributors is not through any of the career agencies, which we know and love about MassMutual. They've been a strong career agency force for 172 years. MMSD is a separate independent agent-focused distribution. There's $250 million that was approved by the board to stand up this new distribution. We have over 100 different employees that are MMSD specific. That's a very, very strong commitment, at least we think so, in the independent brokerage space, where a lot of other carriers are actually having to pull back on their commitment to independent agents and life insurance products. So that's the story why we're here. Let's get into talking about some of the carriers that have been in the independent space for a while. Now, the carriers exiting, I'm not going to name any of those right now, but I think if you read any of the industry publications, you see that carriers are having to make an exit from the life insurance industry, or from having to limit their products, limit premium. I don't think that's something that you're going to have to worry about with MassMutual. It's been a brand name, like I said, for 172 years, a significant player in the insurance space, and that's something that we want to keep going. Demutualization. Again, I'm not going to name any carriers, but demutualization has been going on for the last 30 years. We had a big one recently in the last couple, and that's just something that you're still going to have strong life insurance partners, even if they demutualize, but that's just a signal that things are going to change with products. Again, I think MassMutual is a ways off from any kind of conversation like that. So it should be a place where if you place your client with a MassMutual product, there's less disruption that you're going to have to worry about when it comes to exiting certain products or demutualizing and taking some of the really good things that you want and sold that product for that might have to change. Spin-offs, private equity ownership, there's been a number of those that have occurred in the life insurance space, and that's just something that, again, it starts to test what you think is going to happen with the products that you sold in the past. When it goes to private equity, or if it gets spinned off, are we going to have any changes in charges, or could it change potentially caps? Could it change crediting rates? There's a lot that has to go through your head, and you might have to continually resell those products that are in your book of business. The focus on term and accumulation VUL, I don't think there's anything wrong with this, but it just tells you that as some products become a little bit more capital intensive, harder to manage, harder to administer, there's this flight to ease. And I think term and accumulation VUL, for a number of reasons, are a little bit easier for carriers to be able to manage. But that means that they're taking away some of that focus that they had on products that you relied on. And you don't know if they're going to have to change on any of those things. Some of the products you can think of, GUL, there's been a lot of talk about how those are weighing down the balance sheets of a number of different organizations. And when you hear that, you do start to see more of a focus on term and accumulation VUL. And then reduction in case capacity. This is kind of a big one for us because we are in the big case market. So we have really high retention, $30 million for whole life insurance, $35 million for survivorship whole life insurance, $15 million for a lot of other products we have. But also, we're in the super pool, so it's not uncommon for us to see cases of $180 to $200 million that we could take on. So where other carriers, again, are having to pull back on their commitment from a product perspective, from how they're organized, or what types of cases they can actually take. MassMutual has been very steadfast in being able to take on and live up to the commitments that we've been essentially going on for 172 years. All right, so here I'm actually going to take a breath. And Tim, is there any questions coming up about MassMutual strategic distributors?
We have no questions yet. Just a reminder for everybody, as you think of questions, as I'm sure that you will, just go ahead and type those in the question box on the right-hand side and put those in. And while I'm on the screen here, I do apologize up front. I did miss that note. This is the first of 5 webinars that we'll be doing with partnering with Jeff and MassMutual on. So this is getting us kicked off, and we'll be going into more detail as Jeff mentioned up front. Pop those questions in the question box. None right now, Jeff.
All right. Thank you. All right. So here's the fun part. This is getting to how whole life insurance actually works, and we'll do that by lifting up the kind of the top objections that most agents have, or they feel like their clients would have in the event that they were shown a whole life insurance product. So the first one's too expensive. That's definitely one that when I'm selling, universal life, that I used to think about quite a bit. Another one specific to agents is compensation is far less than whole life insurance, or compensation is far less for whole life insurance than it is for UL. Whole life isn't flexible. That's a huge one because there's a lot of guarantees associated with whole life insurance. And anytime you think guarantees, you think rigidness. You don't think of flexibility. Kind of like GUL. If you don't pay a premium with GUL, or you miss a premium, or you pay too soon, too early, it could throw off that lapse protection solves. So a lot of people are going to try to fit that same kind of narrative around whole life insurance. Dividends are complicated and too hard to explain. This one is definitely well earned by the mutual carriers, because for the longest time we weren't in the independent agent space to be able to explain how they work. So if there's no one to tell you or educate you, you just kind of make up your own story. And when no one's telling you how to make up that story, you say it's too hard. So we'll explain how that we actually get to how dividends are calculated. And then getting distributions out is expensive and difficult. Again, since we weren't able to tell a story, we kind of got to make up what we wanted about distributions. And I think it was painted with a broad brush for a long time, for a good reason, on how distributions come out. So we'll answer to that one as well. So the first one, expenses are relative. I'm going to hit this from 2 different angles, one from a protection product perspective and one from accumulation products. So from a protection perspective, typically we're trying to find the smallest premium to get the largest death benefit for the duration that we need, typically, and hopefully towards or past death, right? So we want to essentially get the least expensive thing that we possibly can. And that's a lot easier to do with universal life for a couple of reasons. One, we have GUL, and it'll just tell you, here's the premium that you need to guarantee coverage out to whatever duration you need, right? Pretty easy. When you're not working with a GUL, universal life has something called flexible premium. And all flexible premium says is, as long as you have enough premium and or cash value to pay the policy charges and expenses, your policy stays in force. So you can calibrate that premium to be able to cover, from a projected perspective, however long you need it to go, which could be relatively inexpensive, especially compared to whole life insurance. Because with whole life insurance, we can't calibrate the premium because we have guaranteed cash value. It has to equal the guaranteed death benefit at age 100. So I'll say that again. Our guaranteed cash value absolutely has to equal a guaranteed death benefit at age 100. The only way you can do that is if you have a guaranteed premium for a guaranteed premium duration. Now, that sounds kind of harsh, it sounds kind of rigid, but there is a lot of certainty in that, to know that if as long as you pay this premium, or as long as you're supposed to, you have a guaranteed policy that's going to pay that claim, and you're going to have a whole bunch of guaranteed cash value. So that puts people at ease. Where on the other side with universal life, again, I'm being very objective here because I appreciate and love all life insurance products. Let's say that you calibrate that premium, you project coverage out to 90 or 100, but the charges increase or the crediting that we're using to make those assumptions doesn't pan out, whether it's IUL, VUL, or current assumption. That's going to cause the policy to call for more premium. So yes, flexibility is great, especially in the early years because you get to project a lower premium, but the actual expense, it's an implicit expense, is that you could be potentially having to pay a lot more premium later on to keep that policy in force, essentially at the time when you probably need it more because you're more likely to die later in the policy than earlier. So from a protection perspective, that's why we say expenses are relative. From the accumulation side, now we're talking about trying to get the smallest death benefit with the largest premium to generate as much cash value and income potentially as we possibly can. So the story's a little bit different because now we're grading all the different products, VUL, IUL, whole life insurance, not necessarily on the death benefit, but in how this same premium across those different products will generate cash value. And when it comes to whole life insurance, we're going to generate really, really strong cash value, but do it with less risk than the other alternative products that are out there. We have a really nice piece that talks about the standard deviation. So how much variation does each one of these different crediting elements, crediting components actually have tied to it? And you'll see that over the last 40 years, whole life insurance has really, really strong return and very minimal standard deviation. So there's not as many swings. Where you see people use whole life insurance quite a bit because of the nature of the cash value, they use it as a buffer asset. For the times when the market might go down, pull from your whole life insurance instead of your market assets. They use it to supplement retirement income, knowing that with a lot more reasonable certainty, there's going to be that bucket of money there to be able to pull from, as opposed to potentially not having what the projection said. So for the right client, any one of these products can make sense, IUL, VUL, whole life insurance. But to manage expectations, I think in the most meaningful way, whole life insurance is going to do pretty dang close to what it says it's going to do on an illustration. So that kind of talks about how expenses are relative, and you can combat those objections, hopefully, in your own head. I want to take a little bit of time to go over our whole life product portfolio. Now, we have stuff outside of whole life insurance. We have GUL, we have a guaranteed SUL, we have a whole bunch of term insurance, we even have a VUL. But I think what most people are interested, especially right out the gate, is how does our whole life insurance product stack up? So we have a 10-pay, a 12-pay, a 15. We have a survivorship 12-pay. We have a 20-pay, a pay to 65, highly cash value that's a pay to 85, a whole life 100, and a survivorship whole life 100. And you see on this spectrum that the further you are to the left, the more accumulation-oriented those products are. Now, there was a little change to Section 7702, and what 7702 is in the IRS code is the definition of life insurance. And that change was significant for whole life insurance because before that change, all whole life insurance products were held to a 4% guaranteed cash value rate, which was significant. And I think over time, with its rates being so low for so long, it was getting harder for whole life insurance carriers to meet that 4% guarantee. So this change allowed whole life insurance carriers to have a guaranteed cash value rate anywhere between 2% to 3.75. Okay? And all of the different insurance carriers could do as they chose. They could make all their products 3.75 or all their products 2% or all their products 3%, or they could do what MassMutual did and be very, very intentional and specific about what guaranteed cash value rate they chose for what product duration. The reason being, the smaller the guaranteed cash value rate at 2%, let's say, the smaller the rate, the lower the death benefit. So the smaller the rate, the lower the death benefit. The higher the rate, the higher the death benefit. A quick example, on the pre-7702 change 10 pay, a 50-year-old putting $50,000 into that product would have got a death benefit of $1 million. Post-7702 change, that same 50-year-old with the same $50,000 would actually get closer to $500,000 death benefit. So what does that mean for the customer? Well, if you wanted death benefit, that's not a good change. But if you're looking at cash value, it was an extraordinary change because you cut the net amount at risk in half, so there's less insurance charges. Your guaranteed cash value is going to be higher earlier, and that means that your dividend is going to perform sooner and longer. So overall, a great accumulation vehicle. Now, the further you go to the right, like I said, you're going to have more protection-oriented products. You're going to typically see those guaranteed cash value rates go higher and higher. So that's how our whole life insurance product portfolio is working and operating today. The second myth or misconception is compensation is far less for whole life insurance than universal life. So we're going to do a little analysis here. Typical street level compensation for target on an IUL is 90% with 2% excess. We're going to use the 55%, and this isn't necessarily street level, but MassMutual comes from a career agency system, and right now our systems that have a lot of career logic in them, especially the compensation. So if you were in a career agency before, you understand how this works. We pay out just that base level commission, and then there's what's called broker expense allowance on top of that. We're only looking at the 55 that we pay out directly from MassMutual, unless you're an agent that's LOA. So 55% target with a 5% excess. What's cool about whole life insurance is that we have renewals that are a little bit stronger than what independent agents have been typically getting over the last 20, 30 years with universal life. In years 2 through 5, MassMutual pays directly to the agent, 10% of target and 5% of excess. In years 6 through 10, we pay directly to the agent, 5% of target and 3% of excess. So over the long term, even with this 55% target number for year 1, you're going to be getting a lot more of a recurring revenue stream than what you're typically used to. And it's very, very meaningful. And I think especially for agents who are registered and you have a lot of AUM recurring revenue, this is something that speaks to you. This is about how you built your business to operate under recurring revenue. Well, now you can do the same thing with whole life insurance renewals, especially knowing that these renewals are not tied to the market. So it's not correlated to the market like your AUM revenue is. So you have a nice little hedge that when the market goes down, your renewals typically won't. And from a business practice perspective, from managing your business, I think it makes a lot of sense to diversify. So especially for registered reps who have a hard time wanting to take AUM and move towards life insurance, especially from how you receive compensation, how you drive revenue, this can help relieve that worry. So compensation can be a heck of a lot more for whole life insurance than universal life. Whole life isn't flexible. This is a well-earned objection because, again, there hasn't been anybody telling this kind of story. So the first way that we'll approach this is there's multiple riders that you can use to customize a whole life insurance policy. The first one is a term blend rider, where let's say that you have a customer who needs $1 million of coverage, and that premium for whole life insurance is $20,000. Well, they only have $12,000 that they can allocate to contribute towards their life insurance program. How can we get a $20,000 premium down to $12,000? You mentioned earlier, Jeff, that it's guaranteed premium, right? That you have to pay this premium somehow, some way. How can I go from 20 to 12? Well, the first way you can do that is with this term blend rider. So we'll knock down that $1 million base to a base level of whole life insurance that with the addition of this term blend, which makes the policy a lot more inexpensive overall, we'll get that premium down to $12,000. You'll still have guaranteed whole life insurance coverage. And over time, as the dividend purchases what's called paid up additions, which is just small chunks of whole life insurance that's paid up, the dividend will keep buying these paid up chunks of death benefit that will be converting that term insurance over time. So typically you'll see that term insurance convert by age 90 or to age 100. So it's a pretty cool story to say, I have this base amount of whole life insurance. It isn't as much as I want, but it's going to grow over time to become that fully permanent insurance policy. We also have riders that can dump more money into a whole life insurance contract. So similar to an UL, where you have a lump sum unscheduled premium, we have what's called paid up additions riders. So if the client wants to dump in an additional 25 or 50 or 10,000, whatever the number, you're able to do that with these paid up additions riders, which is going to purchase these chunks of paid up insurance, and the cash value is going to continually grow after you deposit that money into the account. The next way that we can add in flexibility is with different premium payment options. So I said we have guaranteed premium, and somehow, some way, you have to pay that premium during the premium payment duration. If the client can't or does not want to fully pay that premium out of pocket, they can do what's called our alternate payment option. That's where the dividend, if it's large enough, can then start to pay some or all of the premium. So the dividend can be used to pay the premium. Also, we could do what's called an automatic premium loan, where the loan could pay the premiums. Now, this isn't the same exact thing as flexible premium inside of Universal Life, but it gets you pretty dang close. And so you're going to start having the cash value pay for these different premiums, all the while the guaranteed cash value is continually increasing. And the last way that you can have some flexibility in premium payments, I said you have to pay the entire payment duration. Well, that's not completely true, because if you do want to stop paying premiums outright, you can do what's called reduce paid up. And what we're going to do at that point in time is drop the death benefit down to the 7702 level that meets the definition of life insurance. And then not only can you not put premiums in, we won't allow it. Like, it's just not going to happen, and your cash value will still continue to build. So there is a lot of flexibility that you can enjoy with whole life insurance, whether it's the different riders or the different payment options. All right, so this one is going to be kind of a lengthy one, because dividends are complicated. And again, this is another one that's earned by the mutual carriers, because we weren't there to explain it. So this first slide is going to be the 30,000 foot kind of level view of how the dividend works. So dividends are made up of mainly three components. The first one that I want to talk about is mortality expense reimbursement. So I mentioned earlier we have guaranteed premiums, and part of those guaranteed premiums, what makes those up, is first our mortality expense. We're going to take the 2017 CSO maximum charges that we can possibly take and fit them into that guaranteed premium. That's different than Universal Life, because typically with Universal Life, they're going to take the projected mortality and apply it to the premium. So when folks, again, go back to that first myth of whole life insurance is too expensive, a lot of times they're probably talking about that. They know that we're essentially overcharging mortality risk right out the gate. Whereas Universal Life, they try to use that projected amount, which if things change, that projected amount could actually, that experience could cause them to increase premiums. Well, since we're taking the most we possibly can from the beginning, we can't change it. But what we can do is, when our experience with mortality is better than those maximum charges, the savings between what we charge and the actual experience will go to the participating policyholders in the form of the dividend. Okay, so that's the first place where we draw the funds for the dividend. The second is our expense reimbursement. Now, the expense reimbursement is all of the different things it takes to run an insurance company. You have underwriters, you have case coordinators, you have some salespeople, you have marketing, you have supplies, you have policy administration. All of that gets fit into the premium. What expenses do we think that we're going to drive that year? And we kind of overestimate it. So that way, when we have a better experience, we do a good job of managing the business, the savings from the expense reimbursement are going to go back to the participating policyholders in the form of the dividend. And the last one is investment results. And this is the one that everyone sees. It's the one that everyone wants to talk about. And investment results, especially when it comes to a fixed product like whole life insurance, are mainly driven from the general account. Now, I would typically ask the question if I was in a room of people, hey, do you know what MassMutual's dividend scale interest rate is this year? And most people get it wrong, but it's 6%. So with the 6% dividend scale interest rate, what would you expect that our investment returns would be out of our general account? Well, you think to be pretty dang close to 6%, but they're not. We're actually probably closer to 4.5% of return out of our general account. So how does 4.5% get to 6%? Well, with MassMutual, we have what's called our other business earnings. And these other business earnings are companies that MassMutual owns, where we take the earnings and drive those to the participating policyholders. It's actually supplementing what we pay out in the form of the dividend. What types of companies could these be? Well, Great American was purchased a couple of years ago by MassMutual. Now it's called MassMutual Ascend. A lot of you probably remember Oppenheimer. That was sold to Invesco for MassMutual's stake that we have there. We're now the largest shareholder of Invesco. So there's a lot of companies like that that really contribute and are a large driver of the results for our dividend. Last year we paid a dividend out of $1.85 billion. About $600 million of that came from these other business earnings. So it's a pretty cool story to say that not only are we a mutual company where we're here for the benefit of our participating policyholders and all the earnings are going to go back in the form of the dividend, but we actually own stock companies where, as a shareholder, we're taking those earnings back and then we're driving those earnings to our participating policyholders, which is different if you're with a stock insurance company, which all insurance companies I think are great. But when you're with a stock insurance company, there's a little bit of a conflict there because not only do they have to work and operate on the benefit of the policyholders, but they also have to work and operate to the benefit of the shareholders. So earnings are going to be split between the two, and we don't have to have that conflict. And actually, we're going to be taking earnings from other companies and driving them to our participating policyholders. These slides just kind of explain everything I did on that last slide. And then I know wholesaler math is not optimal, but just to kind of prove how dividends are calculated, it's a little bit easier than people might think. The way that we're able to show this, you start with your ending policy value, you add in your premium, you take out what the mortality expense and the other expenses would be. That gets you a net policy value. So you look at your net policy value, you apply the dividend interest rate, and that's going to spit out a number. That number you add to the ending policy value or the net policy value, and it gives you your total cash value. So that's how you can go in and figure out what was my dividend from, or how do we actually calculate that dividend. All right, the very last one that we're going to talk about today, the very last objection, myth, or misconception, is that getting distributions from whole life policies are expensive and difficult. Another well-earned objection, because for the longest time, and I don't have to say the name of the insurance company, but for the longest time, you saw a lot of 8% loan interest, fixed loan interest rates out there on enforced illustrations. And there was a bunch of carriers in the 80s and 90s and the early 2000s that had 8% loan interest rates because loan interest rates were so high for so long. But that's not the scene today. You can actually get a lot better loan terms when it comes to whole life insurance. As an example, with MassMutual, we have two different forms of loan interest rate, one going off of non-direct recognition and the other going off of direct recognition. What non-direct recognition means, very simply, is that when you have loan value, that loan value gets the same exact dividend interest rate as non-loan value. That's all non-direct recognition means. Direct recognition means that the loan value can receive a different dividend than what we're applying to the non-loan value. Okay, so non-direct recognition, we don't change the dividend. Direct recognition, we have the liberty to change what dividend we credit to the loan value. Okay, so with our non-direct recognition, we have an adjustable loan rate. The adjustable loan rate will never be less than 3%, but it's tied to Moody's composite yield. So as Moody's composite yield goes up and down, so too will the adjustable loan rate. Currently, it's at 5.23%. So with a dividend of 6% and an adjustable loan rate of 5.23, a lot of people like those terms, and it's definitely a lot better than an 8% fixed loan rate that everyone has been applying to whole life insurance for the past 20 years. We also have a 6% fixed rate, and that's on our direct recognition. So that means that we can change what dividend we credit to those loan policy values. Now, the dividend that we credit to the fixed rate with direct recognition can be higher or lower than the current dividend that we set out. In today's world, our dividend that we credit to loan values with direct recognition is actually higher than the dividend we credit to non-loan values. So that's a pretty cool thing when you see on an illustration that you're actually getting more dividend than had you chosen non-direct recognition or not have any loan values at all. Partial surrenders is something that you can do with whole life insurance. A lot of people think that you can't. You cannot do partial surrenders on the guaranteed cash value, but you absolutely can do partial surrenders on the dividends or the accumulation of the dividends. On the dividends, you could do loans as well, but just remember, it's the only part of the cash value that you can do partial surrenders. Okay, so to kind of reiterate that, guaranteed cash value, all you can do is loans. The dividend and the accumulation of dividends can be either partially surrendered or loaned out. The last thing from a flexibility and getting distributions from whole life insurance products is that we have some living benefit riders like accelerated death benefit, which is terminal illness. There's no premium for that. And we have an LTC access rider, which there is a premium for. And it's just an LTC benefit that can grow based off of some of the different rider features and used in the event that the client has an LTC type of event. We also have, just kind of a side note, 2 linked benefit products. We call it Care Choice One, which is a single pay whole life product, and Care Choice Select, which is a 10-pay whole life that have LTC linked benefits tied to them as well. Okay, so if you want just the regular kind of whole life insurance policy, and you want to attach the LTC access rider, you can. If you want that true blue LTC type of linked benefit product, we have those as well. Now, a little bit more on that. You're going to probably get a better LTC benefit with a number of different products out there. But for those customers who you've gone to them 5, 6, 7, 10, 12 times, and they're just not going to buy that LTC type of product, this is the one that you could probably show, and they might come back to you on it because it does a really strong job of generating cash value. So it's something that they could potentially see using, even if they don't think, which most people, especially younger people, do not feel like they're going to have an LTC type of event. Well, this is going to be the best of both worlds because you're going to get that level of protection that will help in the event that does happen, but you're going to build cash value, which will be something that they'll find as an objective that's closer to something they want to solve for. All right, so that kind of does it for my prepared comments. I just kind of want to reiterate why we're in this space in the way that we are, because there is a MassMutual career agency system. So there is a bunch of MassMutual products that are being sold every single day, but why did it make sense for us to jump in with the independent agents? Well, one, because we love independent agents and what they represent, but it makes sense to put the strongest seller historically by product of premium and of volume with the largest selling distribution that's out there. It just makes a ton of sense. And because of that, we wanted to really show our commitment by not just the number of people and resources, but a meaningful amount of money that they use to start up this distribution and provide the commitment to the people who are on this phone right now, that we are not just a viable option from a distribution perspective, but we have very, very strong products that really have a need, especially in this time where there's a lot of uncertainty out there. So with that, Sam, I'll see if there is any questions or comments.
Thanks, Jeff. Just a reminder, everybody, if you have a question, go ahead and put it in that question box on the right-hand side, and we'll get those questions answered. Jeff, I think you kind of commented on this, and maybe I'll ask you again. Or as we've talked, it's not necessarily that whole life is bad and IUL is good, or whole life is good and IUL is bad. It's IUL and whole life are different. And so there's different types of clients that might be interested in IUL, and there's different types of clients that might be more interested in a whole life product. And there might be some clients that have enough funds available to fund both an IUL and a whole life contract because they are different and they don't credit interest based on the same thing. So maybe you get just a super high level overview for everybody on the call. What are, in your experience, what are some of the clients that might be a better profile fit for a whole life product as opposed to our traditional IUL skills?
Yeah, so completely understand that resources are scarce. So your clients are going to be out there and trying to solve different problems, and you have to fit the right kind of solution or solutions. And the best, I'd say the best type of strategy would be a multi-product solution, where if you could do whole life, IUL, and BUL all in the same, or not even BUL, but whole life and IUL if you're not registered, that's probably going to be the best option that you have, because when the IUL is doing great, you're going to feel good. When the whole life insurance is doing everything that's supposed to every single year, I don't think you're ever going to be upset about it. And so you're able to just kind of hedge your bet and get the best of both worlds. And I just think with whole life insurance, it's less likely you're going to have to apologize for something in the future. With IUL, there's so much upside, I think, that you can get with those kinds of products, and you have that floor. So from a marketing story, I don't think there's been anything better out there. It's about managing expectations of what that product's going to do. And, I think that's where, if you are very upfront with the customer and say, hey, a zero with IUL isn't really a zero, because there's going to be some charges and expenses that come out. Just know that if we get hit with a couple of zeros at some point in time, this isn't going to look like it did on the illustration. But that doesn't mean it can't come back up, right? And if you have the whole life insurance as that two-pronged strategy, you hedged and say, okay, the IUL went down a little bit, but at least the whole life insurance did what it was going to do, and we feel pretty good about it.
Cool. So we did get some comments and questions. First one, Jeff, what is your email? If you want me to send that out to the group, I can do that. Otherwise, obviously, we're here to work with you at Financial Brokerage as well, and we can be a good liaison for you. And do you do anything with the GPWL? I'm assuming guaranteed premium whole life. Or if that acronym means something to you, Jeff, I don't know.
Yeah, it kind of sounds like GPWL. It does sound like guaranteed premium whole life. If that's a very specific product, then I'm not completely familiar with it. I mean, all of our products have guaranteed premium, but maybe as a comparison into, if you want to say what carrier that product might be from, I can try to look it up, or if it's at the top of my head, I'll say, I'm very transparent. I'll say exactly everything up to the point where I don't want to get fired or burn a relationship.
No, we did guess wrong. He did comment back and say group whole life.
Oh, group whole life. So there is a part of MassMutual that does group whole life insurance in our worksite area. So I can get that contact information and get it over to you. but
Okay.
that's not something that that I typically help out with.
Thank you. So we got kind of a couple comments here about the infinity banking concept, or the be your own banker concept, very popular on TikTok right now. Can you maybe comment just maybe a little bit on the concept in general, and on the difference between whole life and IULs to accomplish that concept?
Yeah, so the actual be your own banker or infinite banking is not a supported concept with MassMutual. So if you send something in and say this is be your own banker, there's a good chance that they'll turn it away, because the intention, especially in the first year, if you're going to take money out, you can do it. And MassMutual knows that its products are really, really strong for infinite banking and for the be your own banker kind of concept, probably more strong than Index Universal Life. But it does put a lot of pressure on the policy if you're going to, let's say, put $1 million in right now and then try to take out $900,000 right away. And in the first year, every single carrier has to send a little note to the IRS to say, hey, this policy went in force, and within 365 days they took money out, because that's a red flag for anti-money laundering. So you can take money out the first year. You can do loans with whole life insurance in the first year. I would suggest, unless you have a really strong reason for doing so, if you don't want to get flagged by the IRS, you probably wait until the second year. But from a product perspective, can we support it? Absolutely. From a marketing standpoint, it's not something that we are supportive of. The way I look at it, if you're using good judgment and you know that one, they're going to fund the product like they need to, and two, they're going to pay at least loan interest back. If you're going to want to roll up the loan interest, that's where you start to see significant problems, because it's going to start eating into the guaranteed cash value, which could call for more premium later on. So I think conceptually, it's a great idea. I mean, we talk about the JP or the Sears and the Walt Disney stories all the time, where they use those whole life insurance products as their bank. So it makes a lot of sense if you use it more as a common sense cash cushion than saying, it's a bank. I get it. I mean, I would rather pay loan interest to myself than go get a note from a bank. If I already have an asset built that I could tap into for whatever the reason, it makes perfect sense to borrow from yourself than from a bank.
Yeah, absolutely. Any concept where we're obviously using cash value life insurance to get cash out of the contract, that's one of the purposes of having cash value life insurance. So, and then I'll just make a comment on whole life versus IUL. Kind of goes back to the same thing of products are just different, right? So, one of the things that you have as a potential downside when taking loans out of an IUL is, while you do have the 0% floor, when you're using participating loans there, you are kind of tied to the market performance. So if you're taking loans out during a time where you're getting 0% returns, and then you're paying 6, 7, 8% interest rate on that loan, that's maybe not ideal. So yeah. So timing wise,
and I would say even further on the IUL, being a carrier that always sold as IUL, is that we talk about sequence of return risk. With whole life insurance, you don't have sequence of return risk, because your guaranteed cash value will go up every single year. And when you get a dividend, we say dividends aren't guaranteed, but when we pay a dividend, it then becomes locked into the contract and it's guaranteed. So it's not going to go down in the next year. Whereas with Index Universal Life, if you hit a 0, those charges come out. That is sequence of return risk. When you take money out of a contract, your projected illustration that was ran at 6.5 or 7% didn't show taking that money out. And if it did, It didn't show taking that money out with hitting a 0. So it really creates some backlash that you wouldn't expect. So that's why most people, if they understand the be your own banker concept, would prefer to do it with whole life insurance, knowing that there's some challenges with those early zeros and taking money out of an IUL.
Yeah, absolutely. question on, are commissions vested on whole life?
Yeah, so commissions are vested
Yes.
for 10 years with whole life insurance and MassMutual. And when you go through financial brokerage, you own your business. As opposed to if you were a broker that was going through the career agency side through a brokerage director, the general agent owns that business. So you have a lot more control going through financial brokerage than you would have if in a prior relationship that you went through a career agency.
Cool. Oh, and just a clarification, the person that asked the question did not hear about it on TikTok. She is reading a book, and it's on Twitter and LinkedIn as well. Sorry, that was not directed towards you. It's my own personal commentary, because we've had a lot of calls into our office from clients who are actually finding it on TikTok. And so, you know, I remember my first day of training as a new agent, we were always told, you know, nobody's ever going to line up at the door looking for life insurance, right? When we're talking about learning how to prospect and market. And, you know, fast forward now, clients are watching TikTok and calling for life insurance. So it's an interesting, just dynamic, and it makes me internally laugh. It's not necessarily funny, but.
No, it's very funny. The people that you wouldn't expect to be on TikTok have been the ones that have been calling me about it. It's a bunch of middle-aged males who are saying, I heard on the Talk that TikTok, yeah, because they just have their customers calling in, so it's something that comes up very, very often.
Right, very popular concept right now, and definitely a good summation is if you understand it well and execute it the right way, it can be pulled off. And MassMutual, like you said, has a product that can support that. They don't necessarily support it from a specific marketing perspective. So I think that's all the questions that we have. Jeff, any final thoughts from you?
No, I didn't want this to come off as kind of like a downside on IUL, because I truly love the product. You know, just being objective, I think that from a managing expectations perspective, it's going to be, I think, just a lot easier with whole life insurance going forward. Being this time of uncertainty, there's a lot of things that have kind of changed in whole life insurance for the last, 100-something years, 200-something years has been pretty steadfast. It hasn't really changed that much. And the only changes we have seen were with 7702, and those were beneficial to whole life insurance. And if you're feeling like that AG49 or AG49A or AG49A revised, those changes are some things that you're not necessarily feeling too enthused about, a lot of people have been giving whole life insurance a little bit more attention. So I think it's just the right time for whole life insurance for a number of different reasons, whether it's product design, 7702, some things that really are happening to other kinds of products, or just the way the market is.
Great. Thanks for your time today, Jeff, and thanks for everybody out in the audience for not only attending, but having some great, interesting questions to add to the discussion. Keep tuned to your email, or call me if you don't get any emails as we lock down a date for our next webinar, because we will continue to dive deeper into the whole life concepts and help everybody kind of add another source of revenue to their production in their business. So thank you, everybody. Thanks, Jeff. And we'll see you next time.
Thank you.